Welcome to my new stock market options trading show. My name is Eric, and in this episode, we're going to get deep into debit spreads, and we're starting right now. So to really kind of understand debit spreads and why you would want to trade them, I think the best way to kind of get into this is to compare a debit spread with a single option. And the best way to illustrate this is to go to the risk profile. And I'm in Thinkorswim, so I'm going to go to the Analyze tab, and we're going to do a risk profile. And we're going to just look at SPY. We're going to look at a call option and compare it with a call debit spread. And just real quick, the SPY as of this video was trading about 328.46 at the last. I'm doing this on the weekend. So that's the level that the price is at right now. And this is very important that you understand where the price is, because it's going to relate into where you need it to be when you buy a call versus a debit spread. So we're going to add a trade here, and I'm just going to go to the front month October options that nothing special about. There's no fanciness about strike selection. We're going to do that in another video. So let's just look at buying an option that's a little bit in the money, and we'll look at the 327 call option. Now let's look at that on the risk profile. So again, this orange line right here, this is where SPY is trading as of Friday's close, and this is the risk profile of the call option. So you can see that we bought the 327 call option, and if the market were to close below 327 at expiration October 17th, that's this blue line, this is what the option will be worth. Here's the zero line. Everything below this middle line here is a loss, and max loss would be 816. That's the price we paid for the call option. So if the market moves below 327 and if we were to hold till expiration, this thing would go to zero and it would be expire worthless and all that stuff. We're hoping that the market goes up, because if you're buying a call option, you're inherently bullish, right? So the difference here though is that when you look at the price where it is now, this is the profit and loss of the now. This is the T line, some people call it. I call it the daily P&L line. So this purple line is what happens right now if the market were to move up or down. So if the market were to move up in our favor, let's say the market moves up to this 330 level, the profit on this call option would be about, let's call it $85, right? If the market were to move lower, and let's go down to 327, we would be down about $80. But that's just right now. Over time, the current price of the option, which is this purple line, is going to start drifting lower to conform to the risk profile of the option at expiration. This is super important. Theta, if you will, is going to decrease, and the extrinsic value of that option is going to narrow down to where all the intrinsic value of the option is gone. This is where the value ends up. Because remember, if we have a 327 call option, even though the market, let's say the market's settled at 328, this call option would still have a little bit of value, but you'll have lost money on the trade because you paid way too much for it. You paid $800, and at expiration, this thing's only going to be worth it'll be worth $128, because that difference is going to be, just over $1 and change. So you're going to lose a bunch of money. So obviously we think the market's going to go higher. Here's the payoff, right? If you are right in your assumption and the market goes higher, you will make money. But again, if the market moves up and then it chops around at these levels, even though you're making a profit now, over time you will lose money, because the extrinsic value is going to be sucked out of the option and come down to that blue line. So the next thing I want to show is I'm going to put another line on the graph, and we're going to look at the break even. Again, we're still just kind of looking at a single call option. The break even for the single call option is way up here at 335. This is really only important if you were going to hold to expiration, but it still shows that if you held on for a couple weeks, that even though you're trading up here, this line's going to conform back down, and that you really need the market to move past that if you were going to hold to expiration. But it's still I think is important to understand that your break even is way higher, and everything below that is working against you. Time is working against you. The extrinsic value is coming out. So that's sort of the risk reward of a single call option. Again, the market's trading at 328.46. And if we were to buy this call option now, our break even is way up here at we'll just call it 335. Let's remember this level, because as I add trades, these lines start to disappear. So now what we're going to do is we're going to sell an option against the option that we were just looking at to make this a debit spread. So let's go back to the option chain. And the reason why it's called a debit spread is because the cost of this option was, just over $8. So we're going to look at to sell an option that's a little bit cheaper, which is going to be out of the money. And again, the out of the money options have no intrinsic value. So if I sell this option, the difference here is going to be a debit. We're going to buy something for a little bit over $8 and sell something for $6.30. So when you combine these together, it's going to be a little bit under $2 or $200. So that's in itself one sort of benefit of doing debit spreads, is because you're reducing the amount of money that you're going to pay to get bullish, right? So that's one benefit of the debit spread, is I don't have to spend $800. I can spend $200, right, and have a good risk reward. Now, obviously, you can come out in the chain here. I'm not going to talk about this in this video too much, but you can buy options that are a lot cheaper, but the break even and all that stuff is way worse. So, we'll talk about out of the money options in another video, but just the idea that if you want to buy something at the money, by making it a debit spread, you reduce your costs by a ton, depending on how wide you go. I got a whole video on how wide to go coming, so make sure you stick around for that. So right now we got a debit spread here. Let's go to the risk profile. Look at our break even from the call option. It's still way up here, but what you'll notice now is that the risk reward looks like this, right? The risk is now only $182 because we don't have to put out as much money, but we cap our gains, and that's the sort of the give and take, right? That's what you're losing. You're losing the potential that if the market just goes bananas, you're capping your gains, whereas the call option, it just kept going and going and going. There's unlimited gains, but we all know there's a limit. We just don't know what it is, because at some point the option ends, right? Or the options expire. So this is the risk reward. We've capped our gains, but here is the benefit of capping our gains, because no one really thinks that the market is going to go up forever. So we have to factor in some, what happens if it doesn't do anything, or what if happens moves up a little bit or whatever. So let's switch our break even real quick. And the break even now for the spread is way down here at 328.82. The market is trading at 328.46, remember? So at this point, as long as the market just moves up a little bit and stays there, we can be profitable. Where in the other example was if the market moved up, remember, I think we were looking at the 331, 332 level. We won't make as much now. We're only gonna make $20, where in the other example we made, I think, $80. But the time is actually on our side now. If it moves up a little bit and we just hold it there, the spread will start to increase over time, right? Whereas the call option was going to decrease over time, because the current price of the option is going to conform to the expiration price of the option. So if we're down here, the purple line is going to start conforming down. You're going to lose money, right? But if the market is up here, the spread will continue to increase in value over time. So that's one sort of benefit, is that you don't have to be right away. You can just be right a little bit. Let's say the market moves up to 330.5. Well, your $182 that you paid could eventually become have a $100 profit. That's, a 50% gain just by the market not moving lower. Let's do this. Let's move this up to, I'm going to call it 332. So let's say the market were to move up to 332 in the next week. This line changes every day, but in general, you'd be up about $20 in the spread. That's about 10% or something like that. But then time is on your side, and you would, if the market just kind of stayed up here and chopped around a little bit, your spread could still increase in value and doesn't need to go way up here. But if I pull that sold strike off, and here's our call option, if the market moved up there in a timely manner, we would be up $200, right? Which is a little bit more than the other, dollar cost wise. If we had bought 4 of the spreads, we'd be up $80 or so. But with one of those options, we'd be up a couple $100. But time would be working against us, and it would start to move lower. The ultimate kind of comparison is, if the market moves quickly in your favor and you're right away, you will make more money with the call option faster, but you'll have to close because you know it's going to work against you. The debit spread's a little bit, I don't want to say easier, but the timing is not as important, because as long as you're generally right, you can make a decent gain over time, but it's going to take you time for that spread to realize the full value. If you're right away, you're not going to make as much. So that's sort of the give and take of a debit spread versus a call option. It's cheaper to get into. You don't have to be right away. And if you're really wrong, in both cases you would lose money. But in this case, you would lose money, and it would be less because you're paying less money for the spreads. All right, so I got a few more debit spread videos coming to you over the next week or two. So I hope you stick around, and we'll see you at the next video.